All right, welcome back. Continuing our discussion of the equity method of accounting. Hope you guys are doing all right. Sometimes when you buy an interest in a company, there's a difference between the book value of the company's assets and the fair market value of the company's assets. When you buy a company, book value, you know what, that has its place in accounting, but really, the purchase price of a company is dictated by the fair market value of the company, the fair market value of the assets, the fair market value of the liabilities. And it's really, I don't care if the asset is on the balance sheet or off. Like GAAP might say, hey, in process R&D, let's be conservative and expense that. But if I own a company and I've invested tens of millions of dollars in R&D, the buyer and the seller might agree, yeah, there's some value to that. That would add to the cost of the company, okay? So what's relevant when you buy a company is, hey, what's the fair market value of the company? And why is the purchase price different from the book value? And why is the book value different from the fair market value? So it's an interesting analysis, as you're going to see. So when you buy a company, we're going to have to make adjustments, okay? Additional adjustments. And that results from buying a company where the book value is different from the fair market value, okay? But step number one, we want to look at the price you paid relative to first the book value of the net assets. So let's do it step by step. Step number one, we look at the company's balance sheet per GAAP. Let's make up numbers. Let's say the book value of the assets are 1,000. The book value of the liabilities is 600. So the book value of the equity, also known as the net assets, is 400. Okay, let's say I buy a 30% interest in this company and pay 150. All right, so the price paid for a 30% interest is 150. All righty. What was the book value of the equity again? 400. Well, 30% of 400, was only 120. So why did you pay an extra 30? That's what we want to analyze. The excess purchase price over book value. Why did you do that? Sometimes we can figure out why. It's identifiable. Oh, I get it, because the fair market value of your PP&E is different than the book value. Or I get it, it's identifiable. But sometimes the price gets bid up and you can't figure out why. That's unidentifiable excess. And you're going to see, we can't have something on the book, we can't have that unidentifiable. So we got to create a name for it, right? So that we could charge people $500 an hour for our services. You know what we call, I don't know why you paid that amount? We gave that a name. We call it goodwill, right? So step number one, book value of the assets minus the book value of the liabilities. What's the book value of the equity? 400. You bought 30% of this company? Well, that's 120. You paid more than that, 150. We want to know why. Is it identifiable or unidentifiable? Okay. Sometimes the difference is attributed to things that I can see. It's identifiable. Like the assets have a fair market value different than their book value. So in my example, let's say we look at the company's balance sheet and the net book value for the PP&E is 180. But we got an appraiser in there who says, you know what, when I looked at that PP&E, it's worth 200. Okay, the identifiable excess over book value is 20. Oh, I could see why a company would be purchased for more than their book value. That's identifiable. So going through our analysis then, the price paid for the 30% interest, again, was 150. The book value of the equity was 400 times 30%, 120. We have the excess over book value of 30. We're trying to figure out why. We just identified some of that. But you can't use the entire 20 because you didn't buy 100% of the company. You only bought 30% of the company. So the book value versus market value, the excess of market over book was 20, but multiply that by 30%, your percentage share. So you just explained why you paid 6 over the book value. But what about the other 24? I don't know. So you know what we would call that? I don't know. That's unidentifiable. We call that goodwill. The difference is goodwill. So that's one way of analyzing the transaction and figuring out how much of that purchase price is for I don't know, which we'll call goodwill. Let me show you another way to do it. That company, again, that had a book value of equity of 1,000. Well, let's say we take the book value of the assets. The book value of the assets here was 1,000. Let's say we added the fair market value adjustment. So in my example, the book value of the assets was 1,000. All right, we add the fair market value of the adjustment for the PP&E having a value greater than the book value by 20. So now I've got the fair market value of all the assets I can identify, on or off the balance sheet. I don't care if GAAP recognizes it or not. Fair market value of all the assets, 1,020. Let's just pretend the book value of the liabilities and the fair market value of the identifiable liabilities, for simplicity, is one and the same, 600. Okay, the fair market value of the identifiable equity is 120. Now, the purchase price for a 30% stake again was how much? 150. Now take the fair market value of the identifiable equity, the fair market value of the net assets, 420. Well, logically, if that's the fair market value of the equity, the net assets 420, multiply that by 30%, you would have thought we would have paid what amount? 126. But we didn't pay 126. We paid 150. Why did we pay the extra 24? I don't know. So what are we going to call that unidentifiable excess? Goodwill, 24. Same result, different format. The goal for you on the exam is to be able to analyze, why is your purchase price greater than the book value? How much of that can you identify? How much is unidentifiable? So again, in our example, purchase price 150. The fair market value of the net assets, that was 420. Okay, the fair market value of the net assets was 420. Marking up the book value of the assets from 1,000 to 1,020, subtracting the 600 for the liabilities, 420 times 30%. You thought we would have paid 126. The difference between the 150 and the 126, that 24 is unidentifiable. Then the difference between the fair market value of the identifiable equity, 420 times 30%, 126, versus the book value of the equity. 400 times 30% is only 120. So the excess that we can identify is 6. So one more time, if the purchase price for a 30% stake was 150, and we subtracted from that the book value of the equity, 400 times 30%, we need to explain, why do we have the excess over book value of 30? Well, 24 of that, I don't know. It's unidentifiable. It's goodwill. The 6 we can identify. Where did we get the 6 from? Oh yeah, the fair market value of the assets was 1,020, but the book value of the assets were only 1,000. So the book value versus the fair market value, well, that's a difference of a plus 20. Now, we own 30% of that plus 20. Well, that's 6. That's the identifiable excess. So that's your job on the exam, to just be, and all you got to do is just play with it. Start with purchase price minus the book value, get the excess over book value, and then try to figure out, well, why is that? Some of it's identifiable, difference between the book value and the fair market value of the assets. Some of it's unidentifiable. Okay, now let's say we have an example where they tell us the fair market value of the assets is 100. The book value of the assets is only 80. All right, so there's a difference between the book and the market of 20 for the assets. Let's say that's related to PP&E. And they tell us that excess of fair market value over book value, that 20, well, that has a remaining useful life of 4 years. Well, you would take that excess of market value over book, 20, divided by the remaining useful life, and that's going to be called excess depreciation or amortization, $5,000, okay? So that's going to have to be amortized over the remaining useful life of the asset, but not all 5,000, because you're not buying 100% of the company. The excess depreciation, just like your percentage share of the profit, your percentage share of the dividends, you got to find your percentage share of this excess depreciation, okay? Now, be careful. Land is not depreciated. We know that, right? Land is not depreciated. So if the difference between book value and fair market value is due to a difference in the value of the land, that does not get depreciated. We don't do any extra calculation, okay? So in my example, it's related to PP&E. How would this affect my journal entry when I account for my investment in this company? Well, my percentage share, let's say I own 30% of this company, I would have, this is going to reduce my equity earnings. Depreciation is an expense. That 5,000 times 30%, I would have to reduce my equity earnings in this affiliate by $1,500, 1.5, 5 times the 30%. So that makes your net income go down, your retained earnings go down, your and your equity go down. And anything that reduces your carrying value is also going to reduce your earnings, is also going to reduce your carrying value. So not only do we debit our equity earnings, we credit the investment in the affiliate by that same amount. So your equity's down, your assets are down. Okay, now accounting for goodwill under the equity method. Unlike a consolidation, Goodwill is not a separate asset on the balance sheet. Sometimes the equity method of accounting, folks, is known as one-line accounting. If I buy 30% of another company, you know what's the only thing you're going to see on my books in relation to that investment? On the balance sheet, you'll see one line item, investment in affiliate, period, whatever that carrying value is. You don't see any goodwill. And on my income statement, you don't see their revenues and expenses. You don't. The only thing you'll see is equity earnings from that affiliate, period. That's it. So if there's any goodwill, folks, under the equity method, you do not amortize it, nor do you do a separate impairment test for that goodwill, because that goodwill is not a separate asset under the equity method. It's embedded within the carrying value of that investment. So when we do the impairment test under the equity method, we look at it holistically. Okay, we look at the total carrying value, including any goodwill, to analyze whether or not it's impaired. But we do not separately test that goodwill for impairment, nor do we amortize it. All right, excellent example. You ready? Here we go. Big company buys a 40% interest in small. As soon as you see the 40% interest, what are you thinking? Equity method of accounting. Do not mark this to market value. Common stock dividends are not income. All right, they tell me the price paid for this 40% stake, $300,000. Okay, they tell me the book value of the company was $550, yet the fair market value of the company was $600,000. So fair market value of the identifiable equity, $600, yet the book value of the equity is only $550. So we've identified excess of $50,000. Okay, now why is the fair market value of the company greater than the book value? Well, they tell me there's equipment. That $50,000 difference is due to equipment where the fair market value is greater than the book value. That equipment has a remaining useful life of how many years? 10 years. Take the $50,000, divide it by 10 years. What's the excess depreciation? $5,000 in total. Now remember, we don't own 100% of this company. So when we do our accounting, we take the net income of $90,000, multiply it by our percentage share. Our equity earnings from this affiliate, $36,000. They paid a dividend of $40,000. That's not all mine. 40% of that is mine. My percentage share of the dividend is $16,000. That's not income. I get the cash, but that reduces my carrying value in the investment. And then the $5,000 of excess depreciation, my percentage share of that is only 40%, $2,000. That will reduce my equity earnings from the affiliate. So, you ready? How do we go from our beginning carrying value to our ending carrying value? How do we analyze the excess? So let's do it step by step. Let's first analyze the excess over book value. So the price paid for our 40% stake, $300,000. They told me the book value of the equity, that's the book value of the assets minus the book value of the liabilities. The book value of the net assets or equities, $550. Well, $550 times 40%, you would have thought we would have paid $220. We didn't. The excess over book value is how much? $80,000. Now, is that identifiable or unidentifiable? Well, look, they told me there are assets where the market value is greater than the book value by $50,000. Okay, so we can identify 50, but we didn't buy 100% of the company. What percentage share did we buy? 40%. So the $50,000 excess times 40%. Oh, I see why we paid $20,000 more than book value. I get it. But what about the remaining $60,000? I don't know. That's unidentifiable excess. That's goodwill, $60,000 that's simply embedded within the investment account. It is not a separate asset. We can't test it for impairment, does not get amortized. Another way to get your goodwill of 60, same result, different format. Take your price paid of 40% for the 40% stake, $300,000, but subtract from that the fair market value of the identifiable equity times the percentage you bought. The fair market value of the identifiable equity was $600,000. Well, we bought 40% of the company. You would have thought we would have paid $240. Why did you pay $300? I don't know. That unidentifiable portion, what do we call that? Goodwill embedded within the purchase price. So two ways to get your goodwill. All right. Either way, if they just want goodwill is fine, but you want to be able to analyze how much is identifiable versus unidentifiable. Okay. So the first method is really good, but either method will work to get your goodwill. All right. So journal entries. Buy the company for $300,000, debit the investment account, credit cash, total assets, no change, only a change in form. Next step, at the end of the year, the company has earnings of $90,000. Our percentage share of that, 40% of 90 is 36. Debit the investment account, credit our equity earnings, 36,000. Assets up, net income up, retained earnings up, thus equity up, balance sheet is in balance. The dividend paid is not income. So our percentage share of that 40,000 is 40%. You got to debit the cash, but we don't credit dividend income. We credit the investment account. Total assets, no change. Cash goes up. Non-current assets go down. And now to add to the puzzle, the $50,000 equipment market value over book divided by 10 years, the excess depreciation on that is 5,000. But not all of that is our responsibility. Only 40% of that is ours. 40% of the 5,000 is 2,000. That's our percentage share of that excess depreciation on the equipment going from book to market. So we debit, get ready, we got to reduce the investment account. Okay, so we're going to debit our equity, we're going to debit, first we'll debit our equity earnings. Okay, we want to reduce our earnings, and then we want to reduce our investment account. So we credit the investment account. So the equity earnings in this affiliate are debited for 2,000. That makes our net income go down, which makes our retained earnings and our equity go down. And then we credit our investment in that affiliate. That reduces our carrying value. Now, what I really like, and here's your date for Saturday night, going from your beginning carrying value to your ending carrying value so you know what to put on the balance sheet and what your equity earnings are going to be on the income statement. This is how I want you all to practice it. And if something doesn't apply, put a 0. Like if there's no excess depreciation or no dividends, put a 0. But every one of these questions you work, I want you to write this over and over because what you write, you will remember. All right. So beginning investment in affiliate, our cost plus the legal fee, 300. Our percentage share of the net income, 90,000 times 46. That makes our carrying value go up by 36. What I always put next is minus my percentage share of the excess depreciation. 5,000 times 40%, 2,000. Then what I do is those two numbers get netted out. So the 36,000 makes your equity earnings go up. The 2,000 of depreciation makes your equity earnings go down. Big company is going to show on their income statement a single line item, equity earnings from affiliate of what amount? $34,000. Then we have the dividends next. Our percentage share of dividends, 40,000 times 40%. We know that's not income, but that reduces our carrying value. So folks, the carrying value at the end of the period, the investment on the balance sheet, $318,000. Do not mark that to market value unless it's impaired. Don't mark it to market value. And your equity earnings is the sum of your percentage share of the net income minus your percentage share of the excess depreciation. That's the way to do it. All righty. This is how we do it. All righty. Equity method impairment. You ready? Sometimes the asset is impaired. You're going to have to record a loss. Whenever an asset is impaired, you record a loss. You write down the asset and the loss goes where on the income statement. Under the equity method, two things have to be true for you to write down the asset and record an impairment loss. Number one, the fair value's got to be below the carrying value. Rule of conservatism, we can't sit idly by and let the fair value be below the carrying value. We're going to have to write it down so long as it's other than temporary. All right. If it's only temporary, it's not impaired. If it's impaired, that means it's other than temporary. Well, what's the opposite of temporary? Permanent. Why don't they just say that? I don't know. They want there to be a gray area to make you so you can charge $7.50 an hour. Good for you. All right. So equity method of accounting, two things are true. The fair value is below the carrying value and it's not temporary. It's permanent. So this will, if you meet both of those conditions, will record an impairment loss on the income statement. That'll reduce your net income, retained earnings, and equity, and you'll write down your investment in this affiliate. By the way, under U.S. GAAP, for my friends around the world, under U.S. GAAP, this impairment loss is not allowed to be reversed. So even if the fair value goes up in later periods, my IFRS friends internationally, U.S. GAAP, most reversals are not allowed. Okay, so when in doubt, U.S. GAAP doesn't let you reverse it. There's exceptions, but that's the general rule. All right, so here's our example. You ready? Precious Metals just bought 25% of Gems Inc. You see the 25%, you think equity method. Do not mark it to market value. Common stock dividends are not income. All right, they tell me we had a carrying value of $5 million at the end of year one, which is obviously the beginning of year two. So the carrying value end of year one, beginning of year two, $5 million. Okay, that's probably was not the fair market value, right? That was adjusted from their original cost, whatever. Okay, during year two, they had a loss of $80,000. that's going to cause us to reduce our investment account, and that our equity earnings will be negative. So do the math immediately. Don't wait. 80,000 times what percent of that belongs to us? 25%. $20,000 loss is going on our income statement. That's our percentage share. Okay. They tell me Precious Metals Management estimated the fair value of the investment at $4 million due to a permanent, I like the word permanent, closure of 2 factories and a corresponding loss of sales, and management thinks this is other than temporary. So folks, the fair value is only $4 million. What's going to be the impairment loss? You can't do anything at the end of year 2 until you get your adjusted carrying value at the end of the year, and then you compare it to that $4 million fair value. You can't use the fair value at the beginning of the carrying value at the beginning of the year. We first have to adjust that $5 million to get the ending carrying value, then compare that to the fair value of $4 million. So let's do it. Carrying value beginning of year 2, given information, $5 million. Always write it the same way. What's our percentage share of the profit? 25%, but it was a loss. So that's a negative 80,000 times 25%. So that will reduce our carrying value by 20,000. Minus our percentage share of excess depreciation, 0. But the goal with every question, getting our questions right is incidental. The goal of our practice questions is to review the rule in its entirety. If something doesn't apply, then it's a 0. But review the rule in its entirety. Okay, now the negative 20, and then minus the percentage share in excess depreciation, that's a 0. So the equity earnings from this affiliate are a negative 20. And remember, let's just pretend the excess depreciation were 2,000. Then our equity earnings would be a negative 22,000, right? Because that was a loss, a $20,000 loss plus our share of the excess depreciation. Our percentage share of the equity earnings would be a negative 22,000 in total. But here it's a 0. Minus our percentage share of dividends. There were none. 0 times 25%, 0. So folks, the carrying value at the end of year 2, before I do any impairment adjustment, $4,980,000. Now, is that greater than the fair value of $4 million? I'm no mathematician, but I think so. That carrying value is too high, and it's other than temporary. So what's going to be our write-down? We're going to record an impairment loss of $980,000 to get the carrying value of this investment down at the end of year 2 on the balance sheet, $4 million. What would be the journal entry for that impairment loss? You debit the impairment loss, makes your net income go down, retained earnings go down, equity go down. $980,000, credit your investment account, $980,000, okay? And then separate would be your equity earnings from affiliate, a loss of $20,000, okay, on your income statement. All right, and there's the solution, nice and pretty. Again, so that's it. Like, we're almost done with the equity method of accounting, but not quite yet. Come back, we got one more, and then you can practice some questions.